Hey everyone, and welcome back to our channel. Today, we're diving deep into a moment that reshaped our modern world. The 2008 global financial crisis. It was a storm that nearly brought the entire global economy to its knees. But how did it happen? What exactly went wrong? Let's travel back in time and unpack the story. Our story begins in the early 2000s in the United States. The American dream, for many, was owning a home. To make this dream more accessible, interest rates were kept incredibly low. It was cheap to borrow money, and the housing market started booming. House prices were going up and up and up. It felt like a party that would never end. Lenders, eager to get in on the action, started offering mortgages to just about anyone, even those with poor credit histories and unstable incomes. These were called subprime mortgages. On the surface, it seemed like a win-win. Lenders made money from the loans, and more people became homeowners. But here's where the problem started to brew. The risk was being dangerously underestimated. Now, imagine these thousands upon thousands of mortgages, some risky, some less so. Wall Street investment banks had a brilliant, but ultimately disastrous, idea. They bought up these mortgages, bundled them all together into complex financial products called mortgage-backed securities, or MBS. Think of it like a fruit salad. You mix good fruits with some not-so-good ones, and you sell the whole bowl. These MBSs were then sliced up into different pieces, called tranches, based on their level of risk. The safest slices got the highest credit ratings, AAA, the gold standard from rating agencies. This made them look incredibly safe and attractive to investors all over the world, from pension funds to international banks. Everyone wanted a piece of the seemingly safe and profitable American housing market. These complex products were then further repackaged into even more complicated instruments called collateralized debt obligations, or CD. It was like taking the fruit salad, blending it into a smoothie, and then trying to guess which fruit you're tasting. The financial system was becoming a tangled web of interconnected bets, and very few people truly understood the massive risk that was building up, hidden in plain sight. The party started to wind down around 2006. The low initial interest rates on those subprime mortgages began to reset to much higher rates. Suddenly, homeowners who were barely scraping by couldn't afford their monthly payments. Defaults started to skyrocket. One by one, people began to lose their homes. As more houses went into foreclosure, the supply of homes on the market surged. But with fewer people able to buy, demand plummeted. This simple law of supply and demand caused the housing bubble to burst. House prices, which had seemed to defy gravity, began to fall dramatically. This is where the real panic began. Remember those mortgage-backed securities and CD? Their value was tied directly to the value of the mortgages inside them. With homeowners defaulting and house prices collapsing, these once AAA-rated securities were suddenly worth a fraction of their original price. They became toxic assets. Financial institutions across the globe that had loaded up on these assets were now in deep, deep trouble. They were holding trillions of dollars in assets that were practically worthless. Trust, the very grease that keeps the wheels of the financial system turning, evaporated overnight. Banks stopped lending to each other because nobody knew who was solvent and who was on the brink of collapse. The credit markets froze solid. In March 2008, the first major domino fell. Bear Stearns, a major investment bank, was on the verge of bankruptcy and had to be rescued in a fire sale. But that was just a tremor before the main earthquake. September 2008 was the month the crisis exploded. On September 15th, Lehman Brothers, a 158-year-old titan of Wall Street, filed for bankruptcy. It was the largest bankruptcy filing in US history. Unlike Bear Stearns, the government decided not to save Lehman. The shockwave was instantaneous and catastrophic. It sent a message to the world. No one is too big to fail, or so they thought. The fall of Lehman Brothers triggered a full-blown panic. The stock market went into a freefall. AIG, one of the world's largest insurance companies, was next to crumble. AIG had insured many of these toxic assets through instruments called credit default swaps. With the assets failing, AIG faced colossal payouts it couldn't possibly make. Its failure would have been an extinction-level event for the global economy. Faced with a complete meltdown, the US government was forced to act. They stepped in with a massive, controversial bailout for AIG, to the tune of $85 billion. But it was clear that a bigger, more systematic solution was needed. This led to the creation of the Troubled Asset Relief Program, or TARP. It was a $700 billion bailout fund designed to buy up toxic assets and inject capital directly into the struggling banks. The idea was to stabilize the system and get credit flowing again. The decision was incredibly controversial. Many people were outraged. Why should their tax dollars be used to bail out the very banks whose reckless behavior caused the crisis in the first place? It was a debate between saving Wall Street to save Main Street. The bailouts weren't just an American phenomenon. Governments around the world, from the UK to Germany, were forced to launch their own rescue packages to save their own banks and prevent a global economic depression. On the scale of the 1930s, central banks coordinated to slash interest rates and pump liquidity into the system. The immediate crisis was averted, but the fallout was immense. Millions of people lost their jobs, their homes, and their life savings. The world tipped into a deep recession. The crisis exposed fundamental weaknesses in the financial system and led to a wave of new regulations, like the Dodd-Frank Act. In the US, aimed at preventing a repeat, these new rules aim to increase transparency, regulate complex derivatives, and ensure banks held more capital to withstand shocks. Looking back, the 2008 financial crisis serves as a powerful and painful lesson. It showed how interconnected our global economy is, and how quickly greed, complexity, and a lack of oversight can lead to disaster. It's a reminder that when the foundations are shaky, the entire structure is at risk of collapse. And that's the story of the 2008 financial crisis. It's a complex topic, but I hope this breakdown made it a bit clearer. What are your thoughts on it? Do you remember where you were when it happened?